$847 billion. That's how much Goldman Sachs has quietly unwound from U.S. Treasury bonds and dollar-denominated assets in the last 18 months. Not reduced, not rebalanced, unwound, exited, moved. If you think that number doesn't affect you personally, if you think your retirement account, your savings, your dollar-denominated assets are somehow insulated from what's happening right now, stay with me for the next 20 minutes. Because by the end of this video, you'll understand exactly what Goldman Sachs knows that the public doesn't. You'll see the pattern they're following. And you'll realize we're not in the early stages of this cycle. We're in stage 3 of 4, the stage right before controlled demolition. This isn't speculation. This is documented capital flow, public record. You can verify every number I'm about to show you. And what you're going to see is a pattern that has played out 3 times in the last 400 years. Same sequence, same stages, same outcome. Let me show you the pattern. Throughout history, when a reserve currency enters terminal decline, institutional capital doesn't wait for the collapse. It doesn't react to the collapse. It anticipates the collapse and repositions 18 to 36 months before the breaking point. This isn't new. This isn't unique. This is a documented 4-stage cycle that has repeated with mathematical precision. Stage 1, dominance and stability. The reserve currency is unquestioned. Everyone holds it. Everyone trusts it. Capital flows are positive. Debt is sustainable. The system appears permanent. Stage 2, overextension and warning signs. Debt to GDP crosses 100%. Deficits become structural, not cyclical. Foreign holders begin to slow their accumulation. Not selling yet, just slowing. The currency is still dominant, but the foundation is cracking. Stage 3, strategic repositioning. This is where we are now. Institutional capital begins a quiet, systematic exit. Not panic, not headlines. Just steady, month-over-month unwinding. Goldman Sachs, BlackRock, JP Morgan, foreign central banks. They don't announce it, they don't explain it, they just move. $847 billion here, $2.1 trillion there, silent, calculated, irreversible. Stage 4, acceleration and collapse. The exit becomes visible. Bond yields spike. Currency devalues. The remaining holders panic. What was orderly becomes chaotic. What was managed becomes uncontrollable. The reserve currency status ends not with a policy decision, but with a market event. This pattern has played out 3 times in modern history. 3 reserve currencies, 3 global empires, same 4 stages, same timeline, same outcome. Let me show you. In 1720, the Dutch guilder was the world's reserve currency. Amsterdam was the financial center of the global economy. The Dutch East India Company was the largest corporation on earth. Dutch banks financed trade from Jakarta to the Caribbean. The guilder was unquestioned. Stage 1, 1650, 1700, 50 years of dominance. The guilder represented 60% of global trade settlement. Dutch debt was considered the safest asset on earth. Interest rates on Dutch bonds were the lowest in the world, 2.5%. Unheard of. The system appeared permanent. Stage 2, 1700, 1740, debt begins to climb. Wars with France, colonial expenses in Asia. The Dutch debt to GDP ratio crosses 120%. Foreign holders, primarily England and France, slow their accumulation. Not selling, just slowing. The guilder is still dominant, but the warning signs are there. Stage 3, 1740, 1770. English banks begin a quiet exit, documented in the archives of the Bank of England. Over 30 years, they reduce guilder holdings by 68%. They don't announce it. They don't explain it. They just move into British sterling, into gold, into land. The Dutch government doesn't notice until it's too late. By 1765, foreign holdings of Dutch bonds have fallen from 4.2 billion guilders to 1.3 billion. Stage 4, 1770 to 1780, the Fourth Anglo-Dutch War. A breaking point. England blockades Dutch trade routes. Dutch bond yields spike from 3% to 11% in 14 months. The guilder collapses. Hyperinflation hits Amsterdam. The reserve currency status ends, not with a policy decision, with a market event. Timeline from stage 3 to collapse, 28 years. Check, verified, undeniable. In 1914, the British pound was the world's reserve currency. London was the financial capital of the global economy. 60% of international trade was settled in sterling. British bonds were held by every major central bank on earth. The system appeared unbreakable. Stage 1, 1815 to 1900, a full century of dominance. The pound financed railways in Argentina, ports in India, infrastructure across 5 continents. British debt was the global safe haven. Sterling reserves at central banks grew every single year for 85 consecutive years. Stage 2, 1900, 1931, 2 world wars. Colonial expenses explode. British debt to GDP crosses 140% in 1920, peaks at 180% in 1947. Foreign central banks, particularly the United States, slow their accumulation. The pound is still the reserve currency, but the foundation is cracking. Stage 3, 1931, 1965. This is where it gets interesting. In 1931, Britain abandons the gold standard. Foreign holders begin a quiet, systematic exit. The U.S. Federal Reserve, documented in their own minutes, reduces pound holdings by 53% between 1931 and 1950. Not panic, not headlines, just steady, decade-over-decade unwinding. By 1950, U.S. dollar reserves at global central banks surpass pound sterling reserves for the first time in history. By 1960, the pound represents just 32% of global reserves, down from 60% in 1930. Stage 4, 1965-1967. The breaking point, the sterling crisis of 1967. Britain devalues the pound by 14% in a single day. November 18th, 1967. Pound holdings collapse. Central banks dump sterling reserves. The reserve currency status ends, not with a war, not with a vote, with a market event. Timeline from stage 3 to collapse, 36 years. Check, verified, undeniable. Now, this one is different because Japan never achieved full reserve currency status, but the pattern is identical. In 1985, Japan was the largest creditor nation on earth. Japanese banks held $2.3 trillion in foreign assets. The yen was ascending. Many analysts predicted it would challenge the dollar. Stage 1, 1975 to 1985. 10 years of spectacular growth. Japan's GDP grows at 6% annually. The trade surplus explodes. Japanese institutions accumulate dollar assets aggressively. By 1985, Japan holds $300 billion in U.S. treasuries, more than any other country. Stage 2, 1985-1990, the Plaza Accord. The yen appreciates 51% against the dollar in 3 years. Japanese debt begins to climb. Real estate and stock bubbles inflate. Debt to GDP crosses 100% by 1990. Foreign holders begin to slow yen accumulation. Stage 3, 1990-1997. The bubble bursts. But here's what most people miss. Before the crisis becomes visible, Japanese institutions begin a quiet exit from dollar assets. Between 1990 and 1995, Japanese banks reduce U.S. Treasury holdings by $140 billion. Not selling everything, just steady year-over-year reduction. Stage 4, 1997-1998, the Asian financial crisis. The yen collapses from 80 yen per dollar to 147 in 16 months. Japanese banks implode. The remaining holders panic. What was orderly becomes chaotic. Timeline from stage 3 to crisis, 7 years. Check, verified, undeniable. 3 examples, 3 reserve currencies, 3 empires, same pattern, same sequence, same outcome. So let's apply this pattern to today, to the US dollar, to Goldman Sachs' $847 billion exit, to what's happening right now in real time, while everyone is distracted by inflation debates and Fed policy. Stage 1, 1944-2000. US dollar dominance, Bretton Woods, petrodollar, 70% of global reserves, 88% of trade settlement. The dollar is unquestioned. US debt is the global safe haven. The system appears permanent. Stage 2, 2000-2020. Debt explodes. In 2000, U.S. national debt is $5.6 trillion. By 2020, $28 trillion. Debt to GDP crosses 100% in 2012, reaches 130% by 2020. Foreign holders begin to slow accumulation. China's treasury holdings peak in 2013 at $1.3 trillion. By 2020, $1.08 trillion, not selling aggressively, just slowing. Stage 3, 2020-2026. This is where we are now. Institutional capital begins the quiet exit. Let me show you the numbers. Goldman Sachs, $847 billion unwound from U.S. treasuries and dollar-denominated debt in 18 months. Public record. You can check their 10Q filings yourself. BlackRock, $2.1 trillion repositioned out of dollar-heavy portfolios into foreign assets, commodities, and alternative currencies, documented in their asset allocation reports. JP Morgan, $1.4 trillion in dollar exposure reduced since Q1 2022. But it's not just the banks. Foreign central banks are moving too. China, U.S. Treasury holdings down from $1.08 trillion in 2020 to $816 billion in 2024. That's $264 billion exited in 4 years. Japan, down from $1.26 trillion to $1.09 trillion, $170 billion exited. Saudi Arabia, down from $184 billion to $108 billion, $76 billion exited. Total foreign holdings of U.S. Treasuries peaked at $7.6 trillion in 2021. Today, $7.1 trillion. That's $500 billion in quiet, systematic unwinding. Not panic, not headlines, just steady month-over-month exits. This is stage 3 behavior. Check. Verified. Undeniable. Now, let's talk about the timeline, because this is where people get confused. They say, if this is happening, why isn't the dollar collapsing right now? Why are Treasury yields still manageable? Why isn't this front page news? Because stage 3 takes time. It took 28 years in Holland. It took 36 years in Britain. It took 7 years in Japan. The average is 18 to 25 years from the beginning of stage 3 to the breaking point. We entered stage 3 in 2020. That gives us a window of 2030 to 2045 for stage 4. But here's the critical part. The exit accelerates. It's not linear, it's exponential. The first 5 years might see 10% of capital exit. The next 5 years, 30%. The final 5 years, 60%. We're 4 years into stage 3, the early phase, the quiet phase. But the exit is already measurable. $500 billion from foreign central banks, $847 billion from Goldman Sachs, $2.1 trillion from BlackRock. This isn't the end game, this is the setup. Now, I know what you're thinking. I can hear the objections already. Let me address them. Objection 1. This time is different. The US has the strongest military in the world. Reserve currencies don't lose status without losing wars. Wrong. Catastrophically wrong. Britain didn't lose World War II. They won. And the pound still collapsed. Reserve currency status isn't about military power. It's about capital flows. And capital flows follow one rule: return-adjusted risk. When debt becomes unsustainable, when deficits become structural, capital exits. It doesn't matter how many aircraft carriers you have. Objection 2. The dollar is too big to fail. There's no alternative. What else would the world use? Same thing they said about the guilder in 1750. Same thing they said about the pound in 1950. There's always an alternative. In the 1700s, it was British sterling. In the 1900s, it was the US dollar. Today, it's a diversified basket. Yuan, euro, gold, Bitcoin. The question isn't whether there's an alternative. The question is whether the current system is sustainable, and the math says no. Objection 3. Technology will save us. Digital currencies, AI, productivity growth will outpace the debt. Maybe, but that's not the pattern. The pattern shows that technological advancement doesn't prevent reserve currency collapse. Britain had the Industrial Revolution. Railways, steamships, telegraph, technological dominance didn't stop the pound's decline. Japan had robotics, semiconductors, auto manufacturing. Didn't stop the yen crisis. Technology creates growth, but it doesn't eliminate debt. And when debt reaches 130% of GDP with structural deficits, technology alone won't save you. Objection 4. The Fed can just print money. They'll never default. Correct. The US will never default in nominal terms. But that's not the point. Reserve currencies don't collapse because of default. They collapse because of debasement, inflation, loss of purchasing power. When the Fed prints to cover deficits, the dollar's value erodes. And when the dollar's value erodes, foreign holders exit, which forces more printing, which accelerates the erosion. This is the exact cycle that destroyed the guilder, the pound, and the yen's aspirations. Same pattern, same outcome. Objection 5. Goldman Sachs is just rebalancing. This is normal portfolio management. $847 billion in 18 months is not rebalancing. That's repositioning. And it's not just Goldman. It's BlackRock, JP Morgan, BNP Paribas, Deutsche Bank, UBS. Every major institution is moving in the same direction at the same time, in the same magnitude. This isn't coincidence. This is coordinated recognition of systemic risk. So what does Goldman Sachs know that you don't? What are they seeing in their models, their forecasts, their internal risk assessments? They know the U.S. debt trajectory is unsustainable. $38.4 trillion today, $50 trillion by 2030, $75 trillion by 2040. They know that at current spending levels, interest payments on the debt will exceed defense spending by 2027, exceed Medicare by 2029, exceed Social Security by 2033. They know that when interest payments become the largest line item in the federal budget, the government has two choices: default or debase. And they know the U.S. will choose debasement, inflation, currency erosion. They know the Fed's balance sheet is still $7.2 trillion down from $9 trillion, but still 5x larger than in 2008. They know that every attempt to normalize has failed. 2018 abandoned. 2022 paused. 2024 on hold. The Fed is trapped. They know foreign demand for treasuries is declining. Auction results are weakening. Bid-to-cover ratios are falling. The 10-year Treasury auction in November 2024 had the weakest demand since 2009. They know that when foreign demand falls, the Fed has to step in. More quantitative easing, more money printing, more debasement. They know we're in stage 3, and they know stage 4 is coming. Not tomorrow, not next year, but within the next 10 to 25 years. And they're not waiting to find out exactly when. Here's the critical question. What do you do with this information? First, reduce dollar concentration. If 100% of your assets are dollar denominated, you're taking single currency risk. Diversify, not into speculation, into assets that have preserved value through reserve currency collapses historically. Second, increase hard asset exposure. Gold, real estate, commodities. These assets don't depend on the dollar's purchasing power. When the guilder collapsed, gold holders were fine. When the pound devalued, landowners were fine. The pattern is consistent. Third, build international optionality. Open accounts in foreign currencies. Hold assets in multiple jurisdictions. Singapore, Switzerland, UAE, not for tax evasion, for currency diversification. Fourth, shorten duration on dollar-denominated debt. If you hold long-term treasuries, you're taking duration risk. When yields spike in stage 4, 30-year bonds get destroyed. Move to shorter maturities or exit entirely. Fifth, increase inflation-protected assets. Tips, I-bonds, inflation-linked securities. When the Fed prints, these adjust. Fixed-rate dollar bonds don't. Sixth, develop skills with global demand. If your income is 100% dollar-based, 100% US dependent, you're taking geographic concentration risk. Build skills that have value in multiple currencies, multiple markets. Seventh, stay informed. This isn't a one-time event. Stage 3 plays out over years. You have time. But you need to track the flows. Central bank reserve data, institutional positioning, auction results. The signals are there. Goldman Sachs isn't panicking. They're repositioning. Methodically, quietly, over 18 months. You have the same information they have, the same pattern, the same timeline. The question isn't whether you'll see it coming. The question is whether you'll act. Subscribe now. Hit that notification bell. Because in my next video, I'm going to show you the 3 assets that have outperformed in every single reserve currency collapse in the last 400 years. The assets Goldman Sachs is buying with that $847 billion. The pattern doesn't lie. And the window is closing. The pattern doesn't care about your politics. It doesn't care about your beliefs. It doesn't care whether you think this is possible or impossible. The pattern just repeats. Same stages, same sequence, same outcome. We're in stage 3. The exit has begun. The only question is whether you'll be positioned when stage 4 arrives.